Good evening, ladies and gentlemen, and welcome to our financial services event tonight. My name's Steve Thompson. I'm the Director of Financial Services here at Forsyths. It's a fancy title. It means I'm responsible for the financial services business. I joined about 8 months ago, moved to Tamworth and loving it. It's a big country town, like where I grew up. I love it. Welcome to everybody online as well. We've got a big crowd online tonight. We're recording this event so that anyone who missed it can see it. So if you see us talking those of you in the room, you see us talking at the screen or at the camera, that's because we're also talking to people who are online. A little bit of housekeeping. In the crazy event that we have to evacuate, I suggest you follow Lara because she will be panicking. She'll head to the front of the building to the emergency stairs, and we'll all head out that way. But that's not going to happen unless Donald Trump does something crazy. It's not going to happen. The other bit of housekeeping is if you need a bathroom, out the doors and just to the right. But I'm sure you've all been here before. So before we kick off, I'd just like to acknowledge that we're meeting today on the traditional grounds of the Kamilaroi Nation, and we pay our respects to their elders, emerging past, present and future. Tonight's a conversation. It's not a presentation. So what we want to do tonight is give you the opportunity to ask any question you've got that comes up during the night. So it's not just going to be myself or Peter or one of the talking heads on screen who I'll introduce you to in a sec, just talking at you and showing you graphs and trying to baffle you with science. It's a true conversation. If you've got a question, we want you to ask it. Whether you're online and you jump into the online Q&A and put it in and we grab it at the end and one of us reads it out and make sure it gets answered, or whether you're here in the room and there's something you want to know, there'll be plenty of time at the end for us to do Q&A. And also for those of you who are in the room and want to stay and join us for a drink and something to eat, there's plenty of us around to have a chat with. Tonight will take about an hour, and that includes that Q&A, and we want it to be super interactive. So if you're a bit shy and you've got a question to ask, I have this sense for identifying people who don't want to be singled out. So I'll identify you and I'll ask you. So you might as well put your hand up because it's easier. With that said, I want to introduce Peter Bell from Belmont, our investment partners, and he's going to lead you through the next bit of tonight. So welcome, Peter.
Very good. Thanks, Steve. Okay, thanks, folks. Lovely to be here. My name's Peter Bell. I'm a director and co-founder of Belmont. My co-founder, Dave Montoro, is here. Not the most original naming convention. I'm the Bell, he's the Mont. I know. Not terribly clever, but it works. Look, we started working with Forsyths a bit over 12 months ago. It's a real partnership, so we're working with Forsyths to build and manage a suite of portfolios for Forsyths clients. It really is a partnership approach. This isn't just us coming down and saying this is what's going to happen and why. We have Steve and Lara and Ben and Julie and the rest of the team involved in our investment committees, and they're talking about, they're representing their clients. They're saying these are the sort of portfolios that we are wanting to build. They're involved in the investment decision making and so on a day-to-day basis. So look, this is great for us to be able to come here and speak to you for Dave and myself face to face. You know, we get to do the fun stuff of just standing around having a drink and a chat afterwards, but we're going to leave the heavy lifting to the real intellectual firepower, and that's the guys who are on the screen there in that little screen just there. So just before we get going, I will introduce the two speakers for today. So the two speakers that we've got here today, firstly, Michael Block. Michael is our Chief Investment Officer. For those of you who can see all the fine print underneath, Michael is the most ridiculously well-qualified person I've ever met. I'm going to get this wrong, but he's got undergrad degrees in law, accounting, finance, financial planning, philosophy, postgrad in law, economics, economic history, and applied finance, I think. I listed them all. Suffice to say, extremely well qualified. He used to manage about $12 billion for almost a decade at Australian Catholic Super. He's a professor of finance at University of Technology, Sydney, and also has a really great way of being able to express complex issues very simply. So Michael will be talking first on the broad economic environment. Dan Devrich is joining us as well. Dan might not have quite as many letters after his name as Michael, but don't let that fool you. He is an exceptionally talented portfolio manager. He's got a really, really strong background. He was previously at Perpetual as an analyst. He ran a family office for the former head of BT. He has been doing a wonderful, wonderful job running the Australian equities portfolio for Forsyths, and has really made some great calls which benefit the Forsyths clients over the last 12 months or so. So Dan's going to be talking to us a little bit about the Australian equity market, which is probably something that you're all very familiar with. Now, before I hand over to Blocky, Michael Block is known colloquially as Blocky in the office, so I'll probably refer to him unofficially as that. Just firstly, we'll just go to the disclaimer. Important to recognise that what we're talking about, we're going to be talking about the economic environment, investments and so on. But importantly, we don't know your personal financial situation. And so you shouldn't take any of this as being personal financial advice. Nothing is going to replace that value of personal financial advice. So if you're thinking about implementing any of this sort of stuff, please speak with your Forsyths advisor, speak to them about whether it is appropriate given your personal circumstances. So without any further ado, I'll hand you over to our speakers for today, and starting with Michael Block. Thanks, Michael.
Thanks very much, Peter, and hello, everybody. Thank you very much to Forsyths, especially Steve, Lara, Julie, Kurt, Ben, etc., for putting this on. This is me. I'm Michael. Daniel sitting next to me. Just because I have more degrees than a thermometer doesn't mean that I'm much use. At the end of the day, I'm just a bloke like so many of the clients and potential clients of Forsyths, 63 years old, has a self-managed super fund and wants to try and think, what do I do? And hopefully today we're going to try and give you some idea of what's going on in the world, what it means for you, your retirement, and the returns that you're likely to make on various assets. We've got a slideshow, but I'm looking forward much more to answering your questions at the end of the day. Even if we don't get round to everything, by all means, you can send your questions to any of your contacts at Forsyths, and they can send them to us and we can answer them after the event if we need. What I want to talk about today is mostly about what's happening in the US. And let me start off by saying it's a mad, mad, mad world. I've been doing this now for 48 years. Don't let my baby face surprise you, but I'm in my mid-60s and I've never seen anything like this. I've never seen a world where literally what one orange man says can affect everything in the whole world. Hence this slide here, which says that the world is now globalized, it's interconnected, and whatever happens in US economic policies affects all of us. And in particular, our people on the land, because of what it does to the rural community in terms of tariffs and other things like that. I'm sure you've all heard the expression that we had before that, you know, if America catches a cold, sorry, if America sneezes, we all catch a cold. And there's other fancy versions, you know, like if a butterfly flaps its wings in Beijing, what happens in Sydney? But the bottom line is it's all connected, and whether Australia would like to or not, we just can't avoid it. And therefore, what's happening in America today, I'm going to talk a little bit about tariffs, interest rates, share markets. Pretty much it all goes up and down together. The good news I have for you is that the United States economy has been by far the best growing economy, not just for the past 15 years, but much longer periods, but particularly the last 15 years, and it's all because of AI and technology. The good news, as I said, is that US has the lead in this, and you've all heard about the AI stocks, so-called sometimes the Magnificent Seven, not because of the movie, but because there are 7 of them, and these include, Netflix, Google, Nvidia, etc. Unfortunately, there's also some bad news, and that is if you take technology growth and everything that comes from it out of the US economy, there's pretty much nothing left. So the way I often express it is US growth is high and it's from AI. If you take that away, you've got donut, exactly the same as the Australian share market in the small cap stocks. Recently, they've done very well. If you take out the share price gains from gold, there's pretty much nothing else. So it's very important that we be discerning and we look what's behind the numbers and what it means for us. As I said originally, when I went to school, when I went to university, it was relatively easy to think about the way the world worked. People were following standard rules of economics, standard rules of fiscal and monetary policy, and we had an idea of what was going to happen next. Now, as I said, we've got an orange man who on the run seems to blurt out strange policies, whether that be fiscal austerity, one big beautiful bill, tariffs, immigration, goodness knows what. And I would say it's a challenge for us, Daniel, myself, Peter, Monty, everyone here at Belmont, and the advice that we give to foresights in trying to predict what the hell is going to happen next at Trump. I would say that probably one thing that at least I find interesting is that you might think that he's a complete nutcase and doing strange things, but some of it actually makes sense. And that would be if the US government is experiencing a huge deficit and it wants to try and raise some money, well, tariffs does that. I'm not for 1 minute saying that we're in favour of tariffs, because Daniel and I are not in favour of tariffs and we think that it's inflationary. But the one good thing it'll do, it'll mean that the US budget deficit will probably be more like 6% of the economy than 10%. So, as I said, that aside, just something as simple as what's going to happen with the US interest rate decision this week is all very important. At the moment, I think we're at the crossroads. The world is pretty much split into 2 camps. One camp is that the only place where there's going to be growth is the United States, and it's going to continue to be probably the best and probably the only performing major economy. Or maybe the AI bubble is a house of cards. It'll burst. Not only will the US suffer, but that contagion will spread all through the world. I'm very pleased to say that Australia probably won't suffer as much as the US, just in the same way we didn't suffer much in the dot-com bubble of 1999 to 2000. And that's because we simply don't have as much technology stocks and industry as they do in the United States. What do we think the US is doing? I think what I first might do is use Australia as a backwards example. If Australia stopped foreign goods coming into Australia, and the idea was that we would suddenly start making cars and taps and all sorts of other things, that really wouldn't work because we don't have enough Australian industry that we can just turn on. Luckily for America, they do have a reasonably big domestic economy and they may be able to do that. So what do we think that the Republicans and Mr. Trump in particular are trying to achieve? We think they are having tariffs to encourage domestic production, raise some money, and also maybe a subtext is that for so long the US have been the economy that bailed every other economy out by buying their goods and being a free market where everyone could come and sell their goods. I think now the US is pretty much saying, well, we help you, we're a big economy, but if you want access to the US economy, you've got to play ball and do things by our rules. So we'll be very interested to see how that plays out. As well as the tariffs, which are inflationary and which hurt growth, at the same time, the US government is reducing taxes. That is stimulatory and will help make the economy grow faster and do better, and will obviously make corporate profits higher. And lastly, of course, with the Republicans being on the right side of politics and largely believing in laissez-faire economics, they want to deregulate the financial system to encourage a free market, but most importantly, to encourage lending, because with lending comes the ability to borrow and to buy things. And obviously that's always good for the financial markets. What do we think at Belmont? Well, as Steve and my colleagues have often heard me say, if I had a crystal ball, I'd send you a postcard from Monaco with the answers and I'd be living it up. I don't, but what I think I can do is give you an educated guess. And that is that world growth will be slower than it has been recently, but also over the past 30 years. And we think the USA at the moment is likely to perform better than most economies, because the story from AI and the domestic stimulus are still there to help the economy. So we don't think the game is over yet, but certainly the returns that we've all experienced for the last decades, I don't think it's going to be as high as that going forward. So I would class my view as one of cautious optimism. With every view, and being an economist, I get to say on the one hand this, on the other hand that. Everything I said only works if there is not a war, a trade war between China and the US. Part of the reason why the US markets are a little bit stronger this week is because there's rumours that the US and China are likely to reach a truce and a deal in relation to tariffs, where China will pay less than 100% on everything exported to the United States. So now we get to the crux. What does that mean for you or me? What does this mean for our retirement savings? What does it mean for Belmont? And what does it mean for the advice that we give to Foresights and hopefully to you when you become Foresight's clients? Well, let's just have a look at a little bit of history, because history doesn't always repeat, but it's a really good guide when you look at what's happened in the past as to what might happen in the future. As you can see, this is about 35 years of cash rates, Reserve Bank interest rates, and despite the rates going up over the last 4 or 5 years, they are still at extremely low ebb historically. For those of you that are my age, you can see in the very top left hand of this chart, when I bought my very first house, the interest rate that I had to pay to Westpac was 17.5%, and just maybe I got a little bit of the special super duper rate of 13.5% from the savings bank. Contrast that today, where rates are much lower, but obviously housing prices are much higher. I wish I had had the chance to perhaps change this slide after what happened today, but we've been saying that we think that the base case is for 1 or 2 rate cuts by the Reserve Bank, meaning that cash rates should get down to about 3.1%. But today, inflation and other data came out. The way my colleague described it as inflation was a little bit hot. And that means that certainly at the very least, there'll be delay to any rate cuts, and maybe there won't be as many. So if you're now thinking about what that means, there are some people that think the next move will be up and there'll be no more rate cuts. We're in the middle. We think 1 to 2 rate cuts. And up until yesterday, Lucy Ellis from Westpac was suggesting maybe as much as 3 rate cuts. I don't know. But the bottom line is there's really not a lot of great news in the future that interest rates are going to go lower and make all asset prices rise. as well as the rates being low, the extra return that you get from credit spreads is also at a very, very low ebb. So if you go to the bank and you ask them for their term deposit rates, you'll see that they're not much better than the cash rates. And that means that the total return you get, being the interest rate and then the credit spread from investing in fixed interest type areas, is much lower than it used to be. I think this chart should tell you that now is a time to make sure that when you invest money in fixed interest, that you do it in a safe way. Just because things are low now, maybe you shouldn't be chasing highly risky strategies. But we'll talk a little bit more about that later. So if we're sort of looking ahead as to what might happen, if there are 2 rate cuts and the Reserve Bank cash rate goes to 3.1, and if you lend money to big corporates and big companies, you can get another 1.5% over that, 1.4 to be exact, then the total return you can get from safe investment grade strategies is 4.5% per annum. That's okay if the Reserve Bank keeps inflation in the 2 to 3% range. And for those of you on a reasonable tax rate, 4.5 will still mean your retirement savings are growing. But if you tax it at 50%, it's not great news at all. And if you're someone who's trying to live off the return of fixed interest, it certainly means that your returns are likely to be lower than they have been in the future. I beg your pardon, than in the past. Thank you, Dan. This is a chart that shows you how the return on shares have gone against government bonds. And I think what's really interesting is if you look at the right-hand side, you'll see that the dividend yield on the ASX 200, that's a basket of the top 200 shares, is now very, very low. And so once upon a time, when you could put your money in shares and just live off the dividends, it's much harder to do that today than it has been in the past. And again, low dividend yields means high prices, and that probably is something that signals some caution is required because shares are at very high prices. So, as I've said, what does this say you should do and you shouldn't do? What you should do is understand, just like in COVID when interest rates got down to very low levels, there is always the risk that you lose money, and we want to minimise that. So we think now is not the time to start throwing money at risky strategies where you risk the whole 100% of your capital just to try and make an extra 1 or 2%. And it's just unfortunate that credit spreads are so low. So what are we suggesting? The credit strategies that we use, that we recommend for Foresights, and if you join Foresights, that we can offer you is strategies that have a very, very high chance of adding about 2% per annum overall to the return, but we know that we're very safe. And I remember when Lara rang me in April when the credit markets were crazy and the tariff tantrum was going on, and I think her and her clients were assured by me saying that the money was safe and there was a very, very low chance, extremely low chance that anyone would lose any money. Just as well as we don't think you should take too much risk with the credit strategies, we think that low interest rates will force asset prices higher. And now is not the time to buy assets that are expensive and overpriced just because it looks like they've got a good yield right now relative to a very, very low emergency interest rate. So here's what you can do. Continue to hold safe investment grade credit and accept the lower rates, and don't be tempted by higher risk strategies, particularly high risk equities. You'll be very pleased to know when Daniel speaks in a little while that the dividend strategy that we run for Foresights and is available to Foresights clients is having a truly excellent year, and it's made fantastic returns well above the index, and with very high yields. But I'll leave Daniel to tell you more about that. What does Belmont recommend? As I said, we recommend don't add too much risk. We do not think private credit is the answer, but if you do want to try and get higher yields, take the money out of shares, not out of safe government bonds and credit strategies. And within equities, we recommend you stick to tried and trusted strategies of holding good stocks at good valuations. For those of you that didn't know, this is just something for reference, which you can read later on, so I'm not going to spend a lot of time. But when you hear on the television, they talk about how things are investment grade or sub-investment grade, the one we most often use is Standard & Poor's, which is the middle one. And so things that are AAA are super safe, and these are things like Australian government bonds. Everything that's BBB and better is investment grade, which means less than 0.5% chance of losing any money, so pretty safe. So we like to split the world into two bits, investment grade and stuff that isn't in investment grade. And when I now turn to the next slide, here is just some historical data about what happens when things go bad. The point that I'd like to make is that it's not a nice straight line. Once you drop below investment grade, the chance of losing money becomes exponentially higher. And once again, that is why we prefer to stick to everything that's BBB or higher. For those of you that want to look at the rates, you can, but I just say to you that with fixed interest, if everything goes well, the best you do is you get your interest payments and your money back. The worst that happens is you lose capital. And we describe this as uneven or asymmetric risk. And we don't think that's worth taking at the moment. As well as offering multi-asset strategies to Forsyths and their clients, what we also do is we offer a direct equity strategy. It's a dividend yield strategy. It's run by my colleague Daniel, who, as Peter said, is a very, very gifted portfolio manager. And this is where I hand over to Daniel to tell you about what's going on in the share market.
Thank you, Michael. I could get used to this sort of flattery. Lovely to meet everyone, even if it is virtually online. I might just do a quick summary of the sort of high-level trends that we're seeing in the Australian market, and then I'll try and go through it fairly quickly so we can open up to any questions, because I'm sure there's many, and there's always very topical equities. So this is just the 15-year total return on the Australian market, and I've decomposed it into three components. And I think it's important to do that to explain where we are in the cycle right now. So over the last 15 years, the Australian index, so the aggregate of the 200 companies, have grown their earnings at a compound 1.9% per annum. The price return, or the price to multiple ratio that investors are willing to pay for those earnings, has added 2.4% per annum. And the biggest source of return for Australian investors has been dividends at 5%. And then that is a franked dividend, so you would add the franking on top of that. Now, if you were to look at this same chart in the US, it'd be totally reversed, where earnings would be the highest proportion of returns and the dividends would be the lowest. And the reason that is because the tax system in Australia incentivizes Australian companies to pay out dividends, whereas in America it incentivizes them to buy back stock, which ultimately increases the earnings per share in that ratio. Now, having said all that's the average over a 15-year period. The current dividend yield that you get for buying the index as a whole is 2.8%. So almost half of what it has been historically. So that top left chart there is the same chart that you saw before. It's the Australian market dividend yield in the dark blue line, and that's just representing that 2.8%. And it's the chart on the right is basically the dark blue line minus the light blue line. The light blue line is the 10-year government bond In the world of finance, we use that as a proxy for a risk-free rate. So if you buy an Australian government bond, people assume that's risk-free, as in zero chance of getting of losing your money or the Australian government defaulting. The chart on the right is just the dark blue line minus the light blue line, and basically what it shows is when the bars are above the 0% line, you're receiving compensation for the equity risk that you're taking relative to the risk-free rate. When it's below the 0% line, it basically means you're taking equity risk, but you could be buying an alternative asset that gives you a higher yield. And so you're not necessarily being compensated for that risk. Now, I will make one point. Some of you may observe that in 2010, that spread was negative. And you might say, well, that was a bad signal, because if you bought stocks at the end of the GFC, that would have been a great time to buy stocks. And that is true. And so this isn't a perfect prediction model. However, there's a key difference between now and then. Back then, the Australian market probably traded on a price to earnings multiple of 10 times. And today it trades closer to 20. So that is a huge caveat, in that the market this time around is twice as expensive and you're not getting compensated for that risk you're taking. So I just wanted to quickly recap what's happened in the last 5 years, because it's almost been a few business cycles in that time period, whereas a typical cycle might be 7 to 10 years. So we had COVID hit in 2020. The Reserve Bank dropped interest rates to emergency levels, and that pushed everyone up the risk curve. So people started buying riskier assets because everything got more expensive and the yield on offer wasn't there, and so people started going up the risk curve. Markets started to assume lower rates into perpetuity. That's just a fancy way of saying that people expected interest rates to remain low, and so they were willing to take that extra risk. In 2022, we had the supply side shock that was, the Russian invasion of Ukraine. Energy supply was restricted throughout the world, and that pushed the price of oil up. And that ultimately has a flow-on effect into every business in every economy. Their costs go up, ultimately they raise prices. That was compounded by borders shutting, the supply of labour being reduced, and we had the inflationary environment. What happens is the Reserve Banks globally had to raise interest rates, and that forced people to reevaluate how they were valuing assets of all types globally. And so what that meant was, if you went into some of those riskier assets looking for yield, there were certain segments of the stock market, let's call it, that were down 60 to 70% in that year. So some of that technology stuff that I guess people went towards, and some of the higher riskier stuff, you would have been absolutely burnt if that was your strategy. And so we're very mindful that that can happen again. In 2024 to 2025, where we are now, people have started to assume that interest rates are going lower. And we can sort of back calculate how much they're assuming in various different ways. But the market's certainly starting to make the assumption that they're going to be lower. And we feel like right now that hasn't happened yet. So whilst it's expected, it hasn't happened. And so there's always a risk that it won't happen, and then that starts to be reflected in the market. So this is just a couple charts of the inflation and the key indicators that Reserve Banks look when they set interest rates. And so basically the top chart shows the core inflation in the major economies globally. And it shows that back in 2020, those inflation rates went really close to sort of 1% on average. And that's well below the target. And so we got those emergency rates. The point of this chart is to show where the inflation is today on average, and it's probably closer to 3%. And so that says to us that the inflationary environment doesn't necessarily justify the interest rates going lower like the market might expect it. And today was, an interesting data point that we got, and there was some sort of change in opinions as to how many rates will come through. So as we mentioned before, we will not be chasing risk to generate an extra yield when we are managing these portfolios on behalf of Forsyth's clients. We could absolutely increase the yield on the portfolio, but as you know, always our first priority to protect the capital and understand the opportunity cost that comes with getting it wrong. We very much understand that you know, a lot of the money is people's retirements, and protecting it is our first priority. So this is just a representation of how many stocks in the index, in the top 100 stocks, yield more than 5% now. We are literally down to 10 stocks that give you more than a 5% yield. And this is just a representation of where the stocks in the portfolio sit. So quite often the higher yielding stocks can be what we call value traps. The lower price or the higher yield is there for a reason. And so we certainly we've avoided that trap of chasing the yield. And that's just a representation there of where we've got our stocks in the portfolio across different yield levels in the index. So this is just a representation of the actual portfolio. I'm not sure how clear that is on the screen. This just shows you that we are active in our decisions. It shows you the heat map there is the active weight. So basically that's the difference in view that we take relative to the index. And we're basically, our priority in constructing this portfolio is to deliver what we'd call a sustainable level of yield that we can grow through time. That is the number one objective of the portfolio, and that is what we manage it to. So just a couple talking points on the Australian market, what's happened more recently. So tariffs have been the talking point in global markets. Given we focus on franked dividends, we tend not to have a lot of exposure to the US. And so that's actually been a nice benefit for the portfolio. On the right there, you can see the performance of, I've classified it as safe havens or domestic only stocks. And I've contrasted that this year to the US revenue exposed stocks. And you can see there's a substantial widening there of performance between those two names. Given we focus on, you know, what we'd call sustainable, safe sort of companies, that's been a huge benefit to us. The other dynamic that we noticed in the equity markets has just been the sheer volatility in stock price moves. And I've sort of reflected there in the bottom right table showing, you know, these are pretty sort of, a lot of them are blue chip, well-known Australian brands. And these are one-day moves on the back of a result. So, you know, we had stocks like James Hardie and CSL moving 20+% in one day. And so that's certainly, it makes life a little more stressful, but it also creates opportunity for us in one sense. So we're very mindful of the volatility and just wanted to display it for you there. And my last point there is CBA. It seems to be the question that everyone asks. And so I've left that there open for discussion. It is a very expensive bank, and I can take any questions on that one.
Before we do take questions, Dan, you've been very modest, but why don't you tell the audience how well the Forsyth portfolio has done over the last year?
Yeah, we've had a pretty good year. I think in the last year, if we include franking, it's probably up in the order of 18 to 19% as of today. So it's been a very nice run. I'm certainly not going to sit here and expect that to continue forever. But we've made some active calls that the advisors have backed us to do, and you know, we laid out the thesis, and we've gotten a bunch of them right, which is nice, because it doesn't always work out that way. One thing I will mention though is we do place risk controls over the portfolio. So I mean, that's a check on myself managing the portfolio. You know, there are often times where we think we'll be right and we get it wrong. And so we do have risk limits around the portfolio to prevent us, when we do ultimately make that mistake, getting it too wrong. And so they've worked well. And yeah, on top of that, we've made some nice calls and been able to generate. I think the fully franked income on the portfolio return was probably about 6% in the last year. Maybe one of the advisors can correct me if I'm wrong on that, but it's around that 6%, high fives in the last year. But
by the way, how much better is that 19% than the average?
I think the index was about 12 or 13. So I'd have to go back and have a look because it moves every day. But I think as of today, it was about 13, maybe in the last year.
So it's like you've added about 5 or 6%.
But the objective is the yield. So if you own the index, you would have had about 3%. If you included franking, it might have given you 3.5. Whereas we were able to deliver, I think it was between 5.5, maybe fully franked. So yeah, we had a very, very nice year with some special dividends being paid for a couple of the bigger companies.
Thanks very much, Dan. Well, now everybody, I'd like to hand you back to your MC, Steve, and Daniel and I are here ready to help with anything we can.
I'm actually going to hand to Peter.
Very good. Well, look, I really hope we do have some questions. Does anyone have any questions, firstly in the room, on either of those topics, the global economy with Michael or the Australian share market with Dan? I'm waiting a little bit for Steve to start singling people out here. Just one thing I might bring up, and then Michael, maybe if we not sure if we've got any questions coming in online. One of the things that you were mentioning there, Dan, is because we're looking to maximise the fully franked yield on companies, we tend to focus on businesses that operate primarily in Australia. Can you just explain why we need to have that focus and effectively a little bit about franking, what that means?
Yeah, so I mean, franking is a policy that the government basically says we don't want to tax you twice. So the business pays a corporate tax, and then they pay you a dividend from after-tax returns, and you pay tax if it's in your personal name, or depending on what your super, which phase of super you're in, you pay a different rate, and they give you a refund because it's the same income's been taxed twice. In America, they don't give you that refund, and so that encourages firms to, instead of pay dividends, they buy their own stock back. When they buy their own stock back, there's less shares on issue, and so the earnings per share goes up without actually earning any more money. And so generally, we will look for fully franked dividends because it adds to the yield for the investor. Having said that, if the pricing on companies with US dividends goes low enough, then we will include it in the portfolio. We just make the comparison of the unfranked dividend against the franked dividend in Australia. And if one is higher than the other, we're happy to buy it. We just haven't seen that recently. There is one company in the portfolio called Amcor. They're a global packaging company. And it has become very cheap. It's in the portfolio. It's been one of the stocks that we would have liked not to have owned because it's fallen, but it is one where we actually think it's a good company, and we're willing to potentially add to the company when we weigh up the comparison between what it offers and what we'd get in a fully franked dividend from an Australian-only company.
And importantly, Australian companies that have operations in the US or in other countries, the UK, Europe, Asia, anywhere, if they're paying tax in those countries, they don't get franking credits for the tax that they paid in those countries. So Australian companies only earn franking credits, which they pass back to you as shareholders, on taxes that they pay in Australia. So companies that earn all of their profits in Australia and pay all their tax in Australia are better investors, all things being equal, for investors like yourselves who are more interested in income than those companies that make more profit from overseas. So it's just one of the factors that we we go into when we're looking at which companies to invest in the Foresight equity income portfolio.
Peter, we've had a couple of questions from online.
Yep.
One of them, I'm paraphrasing, and it goes back to something Lockie said early on about AI stocks driving the US economy. The question is around, in that AI environment, is it a bubble? You know, I know we talk at an investment committee level about, say, NVIDIA providing, is it OpenAI?
Yeah, financing to OpenAI,
something to open a data center and buy chips and all of that. So can you just talk through, or can maybe Blocky talk through? Or
Blocky, can you just answer that question for us?
Thank you very much for the question. It's not easy to say what's a bubble or not. I'm going to at least give you some facts and then talk you through them. So those 7 stocks, which we sometimes call the Mag 7, they are now worth more than every stock market in Europe combined. There's another stock out there, which isn't technically an AI stock directly, but it's involved in the industry, which is Tesla. Tesla makes 500,000 cars a year. The rest of the car makers in Europe make 50 million cars a year, and Tesla is valued at more than all of them together. Those two things certainly sound like a bubble to me. In other words, when prices are so crazy, like the tulip boom, the silk blight, you know, for that matter, like the 1980s in Japan, when the land under the Imperial Palace in Japan was worth more than the state of California. Anytime you get these things that just sound crazy, it smacks of this is a bubble to me. The only thing which at all I can counter to that is that this time, unlike the dot-com boom in 1999, at least these companies have earnings and earnings growth behind it. So companies like NVIDIA, Amazon, Microsoft, these companies have profits. The profits are growing. The businesses that they serve are growing. And so as yet, the prices are silly, but are they as far as they're going to go? My guess is going to be that all bubbles end in tears. And yes, this will end in tears. But the question is, how much further will it run first? And I don't know the answer to that. But with that in mind, we at Belmont are holding less AI stocks than we ordinarily would. So if you're interested in the portfolio settings that we've recommended to Foresights, those are to have a little bit more Aussie dollars, a little bit less US dollars, because we think the Aussie dollar is going up, and a little bit less US and AI stocks because we think they're very expensive. But I'm not quite ready to ring the bell and say this is a horrible bubble. The jury's still out. My guess is that if you think of it like a sporting match, we're getting towards the end of the game, but I don't know whether we're in the last innings of the baseball game or the 7th. But time will tell. I hope that helps.
I hope it answered the question. The other question we had has to be from a Belmont Foresight's client, because historically we know Foresight's clients love Australian banks. And I'm just going to bypass you here, Peter, and go straight to Dan. Dan, the question is, on Dan's slide, he said CBA, 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 exclamation mark. What does that mean?
I might butt in before Dan, and so this is where I say something with great embarrassment, that my children are making higher returns on their investment portfolio because they have lots of CBA. I may add one of them is just sold, whereas on the other hand, me as a layman thinks that CBA is now in ridiculously high prices. Daniel will take you through the numbers, but generally banks trade at somewhere between 2.5 and 3 times book, and CommBank's well over 4. So it's pretty much the most expensive bank in the world, and I think way too rich. And we hold as little of it as we can. This is where I pass on to Dan.
Yeah, this is where those risk controls come in, just to keep a check on me if I'm wrong. So it means whatever the audience wants it to mean. It's a very it's probably the most recognized brand in Australia. It's the most talked about stock in my, 15-year career now. I've sat in investment committees where people, no matter what I tell them, just don't want to change or never ever want to reduce it, which is, to be fair, been the right call over the last 15 years. You would have done really well by not selling one share. Just as general comments around Commonwealth Bank, it is an excellent bank. I have no worries about the bank with anything fundamental. It's got, to use the technical jargon, one of the lowest cost to income ratios. It's got a better deposit franchise, which means it gets cheaper funding for it to ultimately lend to other people. It is a superior bank to the other three when it comes to profitability metrics. But all that, I guess, culminates into a price that you should pay for it and a price where we think it shouldn't trade. And when I look at it, it's gone well beyond that price where it shouldn't trade. It's now in the nosebleed territory. And so we just take the view that, if it's offering us call it 2.7% yield, yes, that yield is very safe, but I think the perception in Australia has become that that yield can't disappear, or the earnings can't go down, or the dividend can't be cut. And I think that's a bit of a fallacy, or we call it recency bias, where we haven't had a default cycle in Australia. So I mean, we've had, with the exception of COVID, which was a bit abnormal, we've had 30 odd, maybe more now, years of economic growth and interest rates being lowered, and the probability of people defaulting just going down. And we're in a situation now where there's effectively no bad loans on the balance sheet. So what that means is there are, we'll call it less than 0.1% of loans that aren't being repaid. So from where I sit, and the way I think about that is, it can only get worse. It can't get better from a default point of view. Now, that doesn't mean it has to get terrible, but the way it's priced is everyone's assuming that it's never, ever going to get worse. And so we just say we're not being compensated for the potential risk that's there. And so we're just being a little bit cautious, and we carry less Commonwealth Bank than the index does. Now, the pushback is usually, I've held CommBank for 30 years and I got a huge capital gain. Well, I have to pay a tax if I sell it, and that's fair. And depending on what your tax rate is, that can make a difference to the decision. But typically, to us, it's that overvalued now that it's probably even worth paying the tax. And I'll say that, with caveats at not knowing what everyone's individual tax rates are.
Dan, if somebody came to you with new money,
Mm-hmm.
would you rather buy one of the other banks?
Yeah.
Or a different sector altogether?
Look, I think the banks provide a very reliable source of income. So, the Australian banking system is one that is different, I guess, to what it is globally. We have 4 main banks that dominate the market, and that provides incredible stability. The change over the years has been that the regulators have forced them to de-risk by holding less leverage, and it's also forced them to increase the standard that they uphold when lending money. And so what that means is the system has really become one where if you don't earn enough money, you can't get a loan. And so it's really the higher sort of socioeconomic cohorts now that are the borrowers. Whereas maybe yesteryear it was there was a lot more risk or a lot more lending to the lower socioeconomic cohorts of society, and so all that does mean that the banks are a very safe source of income, but Australia really hasn't been tested when it comes to a recession or anything of the sort, or an abnormal real event. And so whilst I definitely allocate a portion of the portfolio to banks, and we do, There's certainly other areas of the market where we might look to put the marginal dollar.
Thanks, Dan.
Thanks, Dan. Any other questions? We're going to be wrapping up in a couple of minutes. So if you do have any questions, please don't be shy. Great.
So I knew we were going to get that exposure. I would have got Matt Common to come along.
Dan, you can't see Craig, but he's in here with he's got this little yellow square on his shirt. So it was, he's not a plant.
What's have you been?
We'll still take your money.
I'm sure you will, and you have in the past.
Well, I think everything I said is probably a credit to Matt because the share price has gone up so much under his tenure.
Yeah, absolutely.
Agree 100%. Just going back on Michael's comments earlier about the US economy, thinks it will continue to grow at the moment, but depending on a few things, and as well as Dan mentioned that it was through the speech, it was like it was not wanting to be aligned with the American. It was good that you weren't over a period of time, but considering that growth and when Trump was last in, there was a fair bit of business growth in both America and Australia, I believe, over that period of time, and understand the risk adverse side of things. But what's the strategy on potentially aligning yourselves with some sort of businesses or stocks that are more aligned to the US market?
Look,
well, there's good news and bad news. Let's use a couple of case studies, and remember it's a little bit hard because there are some stock specific situations, but James Hardie, a large company, gets a significant portion of its income from the United States. If housing was doing well in the United States, that would be great for their business. And last time I checked, Hardie's was nearly 30% lower than when I looked before. So especially given that we think the Australian dollar is likely to go up, that means stocks held in the United States, all things being equal, will fall in Australian dollar terms.
I think there's multiple aspects to that question. So if we're looking at the multi-asset suite that we provide the clients, there is an allocation to international equities. Now, to combat the risk of the Aussie dollar going up, we have hedged that portion of our allocation. But if we look at the international equities, the US is, let's call it 75% of the index. And so we definitely have an exposure to the US. The views from Michael was that we still think that economy is going to do well. And, as a result, we are invested alongside those views. But we are also mindful that the valuations are at a historical high point. And so we just want to be a little bit cautious. When it comes to the domestic allocation, because of the objectives of this portfolio is specifically to generate yield, Australian companies, because of that franking demand, tend to pay income, and that is the focus. Obviously, we will look within the objective to try and generate the highest return, but we are trying to generate a yield. So if I was just looking from a total return perspective and not worried about the yield, there certainly might be some American business that I'd put in the portfolio, but because they're reinvesting for growth, which means that they're not necessarily paying that dividend out. Now that comes with a higher risk profile, but it also comes with a higher total return potential. But that's for this specific portfolio, which is one section of the multi-asset suite that we run for the clients. That's not the objective of this specific portfolio. So we're focusing on companies that pay yield, and for the minute that just tends to be more Australian focused. That's not to say we have none in there. Like Macquarie is a business that has US operations. Amcor is a business in there that has a large footprint in the US. So there is some exposure, but some of those other sort of, I guess, growthier orientated names, if they don't pay a dividend, we're probably not going to consider it.
Just before we wrap up, I'm going to add one more thing to that. So there are occasions where we can find that nice overlap for companies that have exposure to those growth elements but still pay a high, attractive, fully franked yield. So one of the examples of that in the portfolio at the moment, which we added, I think probably about 6 months ago, is a company called Data3. Data3 Limited is Australia's largest IT services provider. So they are effectively a reseller to large corporates and government for IT hardware and software. And so that includes one of the biggest partners is Microsoft. Microsoft, of course, is one of the big beneficiaries of AI because when we're talking a large corporate or the government, they are looking, how do we incorporate AI into what we do to make ourselves more efficient? They're going to be speaking with their IT services provider, Data3, initially as a consultant, and then as the agent for the software and hardware that they need to be able to provide that to their through their business. So Data3 is rare in that they pay a very high dividend, and it's been growing at a pretty solid rate. And I think in the quarterly report, which will be coming out the next couple of days, we noted since we bought it, the dividend has grown by 16%. So they pay a good dividend, they're growing their earnings, and they're paying fully franked dividends. So we're getting exposure to some of those thematics, but doing it in a way that's generating that high-end fully franked dividend.
Thanks, guys.
All right. Thanks, everyone. Look, can I get everyone to thank Dan and Michael for that? I think it's been really good to have you here. They really do have exceptional experience and capability in this space. So I think it's been really, really handy. So
Thanks, guys.
look, very good. All right, we'll hand back to Steve to wrap things up.
Thank you. So thank you to everybody. Thanks to the to Blocky and Dan. What I hope that showed you is how closely our advisor team work with the guys at Belmont. So when we have our investment committee meetings, for example, Belmont will put a proposal to us in terms of we want to simple terms, we want to move this stock out of the portfolio, put this stock in. Our advisor team, who know our clients intimately, will then sit there and give an opinion as to how that will be received by our clients. So every investment committee we talk about CBA, every investment committee, and it was a red piece on Dan's heat map. I couldn't read the number, but I know the number. But we talk about it every meeting, and every meeting our advisors go, but our clients love the banks. So there's this tension. So what we get from Belmont is expertise in that direct equity space, combined with our knowledge of the clients and how Forsyth wants to run money for you. So I thought that was great. So thank you, guys. Everybody who attended, plus everybody online, will be sent in a little short 3-4 question email survey just to get your opinion on how tonight went, other topics you might want to hear about, other ways we might do this. So please, I encourage you to fill that in. For those of you here in the room, you got one of these. This is one of our brand new Forsyth's luggage trackers. You track your luggage, we'll track your money. So the Belmont guys told me to say that. No, seriously, it's just a little thank you from us in this age of cybersecurity, hacking, phishing, all that sort of stuff. We didn't want to give you something to plug into your laptop. We wanted to give you something so that when Qantas lose your bags, they know where they are. For those of you staying with us, we've got some drinks and some nibblies. Please feel free to hang around. We've got most of our Tamworth-based advisors in the room. Lara, Ben, Jules are all here, plus some more of our team. If you would like to talk to one of our advisors, please take the opportunity, as well as Peter and Dave from Belmont. So thank you very much, and please join us for a drink. Cheers.
Thanks, everybody. See you later.